The market is about to crash.
We've analyzed data from the previous crashes to figure out exactly how the market's about to play out.
Welcome to the Bean Pod. This is your place for all things stocks and crypto. From beginner tips to expert picks. Use this as fuel for your investing journey, because when you're in the know, your money will grow.
This episode of the Bean Pod is sponsored by KyberSwap.
KyberSwap is a DEX and DEX aggregator, which is built to facilitate all your DeFi needs in one single platform.
Fast, cheap, and safe.
User experience is KyberSwap's sole focus to make everyone's life better in DeFi. Welcome to the Bean Pod. This is Shane, aka the Jolly Green Investor.
And this is Josh, the Nifty Investor.
We figured out exactly how the current market crash is going to look like.
We've looked at previous market crashes to figure out exactly how this market crash is about to play out.
So I don't think you can really deny it at this point. The market is in a heavy downturn. You know, crypto's down 60, 70, some 80% from the top. The S&P 500 is rolling over significantly. So I think it's time to look at previous market crashes and find some clues to maybe find, where the bottom is going to be, what's caused the crash, and, maybe some plays that we can do learning from past things.
Absolutely. So, the most recent crash that we have in the stock market would have been the pandemic, first of all. But that was a V-shaped recovery. That was like, boom, what's going on? The world shut down. But then there was a ton of quantitative easing, where the governments were handing out money. So all this money poured into the stock market while people are sitting at home kind of gambling on crypto and stocks, which sent it right back up.
Yeah, so it's probably not the best comparison, right? It was kind of an anomaly, that one.
Exactly. So maybe if we go back a little bit further, we could look at maybe the 2008 great financial crash. That might be a little bit more comparative.
I think so, because it's a global phenomenon. It's something it was lasting, It took years to really figure out the impacts of what was wrong with the economic systems. And I think there's a lot of similarities between the crisis of that time and now. So let's look back at 2008. So the great financial crisis, the GFC, what was the main cause of that?
That was the mortgages.
Right.
So there's as mortgage lenders received regular interest payments, and it was a really easy way to profit at the time. So the tech sector kind of took a tumble, and now stock investors are like, all right, where can we put our money? Mortgages were the best place to put them. There's super low interest rates. Everybody was pouring in and buying mortgages. So you had these super big lenders and you had unqualified buyers purchasing all these homes, and it was predatory. The loans that they were handed out were predatory. And basically what happened was it became this vicious cycle. And I guess, to really go a bit further into, there's a lot to this one.
There's a lot to it. If you've seen The Big Short, there's a lot of good information in there. It's basically there were super low interest rates, and people were encouraged to borrow beyond their means.
That's right. Yeah.
Right. So they were getting this money that they couldn't really afford to borrow, and then when the house of cards tumbled, shit hit the fan, and it built up over years and years and years. These subprime mortgages, and then real estate being one of the pillars of any economy, eventually took down the stock market. So I think it was the S&P 500 fell, I think, nearly 50% from mid-2007 to March 2009. So that's one of the first things that we can look at to compare to now. So from the top, which was October 2007, the bottom was March 2009. So everyone's, they're calling, the Bitcoin bottom's already happened. The stock market's already bottomed, buy. But if you look at the past crash, it was a year and a half from very top to very bottom. So from the top, which was December 2021, we're still only 7-8 months out from that. So we still have a long way to go. That's the first thing that I learned.
It was also it was a different cause. So you had finance companies who were involved in this real estate game that eventually took the hit. So investment banks flooding the market with foreclosed homes, supply outpaced demands. All the finance companies were involved in this game, right? So September 15th, the largest bankruptcy in U.S. history occurred. This was the Lehman Bros. They were an investment bank with $600 billion in assets. When that goes under, that's $600 billion. This is one of the largest asset managers in the world.
Yep.
And people started fleeing the market because they were so afraid. Like, what are we supposed to do here, right? So any companies associated with the assets that were under this umbrella, in addition to the housing crisis, countries started to pull out of the U.S. stock market as well, which caused it to crash.
Yeah. So it was a bit more of like a deep-rooted systemic failure of policy. Not to say that the policies have not failed us this time. And it's important. And as we go on in this episode, we'll uncover some more similarities and stuff. Because one of the things, the outcomes of the 2008 crash was a more activist Fed. Right.
Financial institutions are the ones who essentially caused the crash.
Yeah. So the Fed has then stepped in after 2008 and has basically been pumping the markets full of free money for 14 years.
Yeah.
And now, unfortunately, the time is up. And the COVID crash was basically just like the tip of the cherry on top. You know, like if you look at you zoom out, you look at the SPY chart for the past 20 years, it's basically just up since the GFC. And then there's the little dip for COVID and then just vertical. And, you know, as a long-term investor, you would have to look at that and be like, this is madness.
Yeah.
So now, unfortunately, we have to deal with the consequences of the activist Fed coming in, printing an unlimited amount of money for the past however many years, and especially since COVID. You know, trillions have been printed in the past 2 years. And it all kind of started from the policy switches that came from the 2008 crisis, which is why it's so important for us to understand that.
That's right. This crash is a little bit different, the one that we're experiencing now, right? This is caused by like global inflation. You have supply chain shortages. You have, people who are not going back to work because they don't want to work. So you're having an issue. You have an energy crisis over in Europe. So you have companies are trying to make up for losses by inflating their prices to cover the energy costs, but then they don't have the money to pay the workers. So they're doing layoffs. This is a much bigger issue here.
It's almost like a sum of a bunch of issues that's come up into one. And the energy crisis, I feel like that is really just starting to rear its head, as we head into winter now. I think there's going to be some very, very bad things going on over in Europe. The energy prices are soaring out of control in Germany, with Russia holding supply of energy and oil and gas and all that kind of stuff. And I think you're going to see that start to be reflected in bottom lines of companies, probably in Q1 or Q2 of next year, because with soaring energy costs, this is going to affect consumers, businesses, everything globally. And as people kind of tighten the reins on their spending, businesses are going to be hurt. Consumers, they can barely afford to pay their hydro bills, so they can't buy anything. I think that is where we're really going to see, some of the worst economic numbers come through. And if you look at the 2008 crisis and how long it took to bottom out, that kind of times up with what's going on right now. So if shit hits the fan we really start seeing it Q1, Q2 of 2023, then potentially the market bottom could be mid-end of 2023, which lines up with a lot of other things we've been researching, right?
I mean, also I wonder if, because the 2008 crisis was caused by the U.S., right? That one was all the countries and companies associated to the U.S. within this lending market for the mortgages. This one is global. So there's so much. I guess I was looking at some data and the U.S. specific factors alone. So everybody's like, oh, why did they print so much money in the U.S.? The stimulus package was like $5 trillion.
It's insane.
But every country was handing out money, right? Canada was handing out $2,000 a week or $2,000 a month to 33 million citizens. That's a lot of money. Other countries are doing that as well. So they're saying that the U.S. stimulus package may only explain 1 to 2% of the current inflation rates.
That low, eh?
Yeah, really, really low. Wow. So this is a global issue, right?
It's a global crisis. I mean, when you look at all the factors that you were just touching on, like home prices are insane right now. No one can afford the home prices. Everything's inflated. Supply chain, the conflict in Russia and Ukraine doesn't help. There's just so many things going on when you look at the macro environment that lead us to believe that, one, we haven't seen the worst of the market crash yet. And as you kind of touched on before, 80% of all US dollars in existence were printed in the last 22 months. That number right there is just insane. So when you look at all this free money being pumped into stocks and crypto, and now only just they've only just started with their quantitative tightening. So as the Fed chair comes out, Jerome Powell, now every month he tanks the markets because we're not pivoting. We're raising interest rates and we're taking money out of the markets. And they're going to keep doing that for the next, year.
So here's what I'm thinking, though. Here's what to the global factor is because the U.S. is not the sole contributor to this. There's all these other factors at play, right? If they keep raising interest rates, which is great, but like, what is that really doing if there's a supply chain shortage and they're not getting their parts from China or you're not getting your energy from Europe? Is raising interest rates at home really going to do anything? It's going to curb some demand within your own region of the world, but this is a global issue.
Yeah. I mean, I guess just the fact that the States is still the global powerhouse, and even though that is only America, I feel like their financial policy has such a huge impact in Europe and Asia and around the world because they're trading with everyone, and the US dollar is still the king of the, foreign exchange market. It has an effect on everyone. Even if it is just American policy, I feel like it still trickles down.
And I guess it's all countries raising their interest rates as well. I know Canada's doing it.
Yeah.
Europe's doing it. So,
and you can see the signs that everyone's humans have a tendency to kick the can down the road and not deal with problems. And this isn't even just financial things. This is just everyday shit, right? So you kick the can down the road because you don't want to deal with problems. And it's even it's whatever you're dealing with in life. And I feel like they're just continuing to do that, continuing to kick the can down the road. Even a sign like they changed the definition of what a recession is.
That's right, yeah.
Biden, he sees the data. The traditional definition of a recession is 2 consecutive quarters of declining GDP. Well, they see that data and they say, oh, no. Now it's all this stuff. You have to look at retail sales and unemployment numbers. And we are still not seeing these numbers coming down. So we're not in a recession. It's like, well, yeah, fuck off.
Yeah,
we're clearly in a recession.
Like Wikipedia had like 300 edits or something the next day.
What a joke.
It's just like, I'll just rewrite what the definition is.
Yeah.
I mean, that's good for the markets.
Yeah, it hasn't been lately, but yeah.
They're going to have to change what the definition of depression means, I guess, next.
Change the definition of the stock market.
Yeah.
Yeah. Just change everything and then be like, look, we told you. Yeah, it's pretty brutal.
All right, so this time around we have, demand bounce back far more quickly than expected after the pandemic. We have prices soared because demand outpaced supply. And there was a big shift to goods, actual tangible goods and services, because with the lockdowns, there was no services. So we've created this huge bottleneck now where I think you're seeing a bunch of layoffs right now, right? You're seeing all these companies, and I think this is a good thing because if people don't have money to go spend, it should in theory drive down the demand, and the supply should start to come up because people are getting laid off. So you have these companies laying off 20,000 people, 20% of their workforce. I think this will be a really good thing, the layoffs that are now starting to occur.
Right.
It's going to be kind of shitty, and it could put us into a stagflation or a recession, but it's also ultimately going to bring down inflation as well.
Yeah, I think so. Well, what was the one? It was Shopify laid off like 25% of their staff via email.
Yeah.
People are just like out on a weekend. It's just like, you've been terminated.
Oh my God, that's brutal.
Yeah, there's some pretty
but think about that, right? So if they're not making money now, they can't go out and spend. So, all these people have been gouging with the inflation rising. It should in theory bring it down if people aren't out spending.
Yeah, I think all these, economic factors, kind of everyone pulling in the reins and things declining, will eventually bring down the historic inflation that we've seen.
Yeah.
I mean, you just look at some of the other stats I found. So 40% of Americans are struggling to pay their daily and monthly bills right now, which is more than any time since, pre-pandemic. So people are really starting to feel the pinch here. And now we're seeing the real estate market start to tip over as well, right? We just had the biggest drop in average and median new U.S. home prices since 2008, since the last real estate crash. So we're starting to see some signs of things coming back down to earth, which is what the market needed because everything was just so inflated. Everything from real estate prices to stock prices to crypto prices. Everything was just pumped full of free money. Mm-hmm. You give a country $5 trillion and obviously everything's going to become way more expensive.
So I wonder if they're going to eventually pump money back in to the markets.
A lot of people are calling for that Fed pivot, right? They're like, oh, well, everything's so bad. You can't keep raising interest rates while the world is collapsing around you. But it's a tricky one. It's almost like if they do, then they have no credibility.
Yeah.
It's like, will they bring down the world economy just to save face? People have done stupider things in the past.
What was it? 2006. I put up a chart on Twitter the other day. It was over the course of like 3 years. They raised interest rates 25 basis points for
Every month.
for 3 years.
Yeah, but that
So
could be where we're at now.
they've done it. That's why I was like, I don't think we're going to see a pivot anytime. The Fed just came in. I said they weren't going to pivot until at least 2023.
No, I don't think so. So, I mean, look, we've got all these bad factors and, studying the 2008 crisis, the causes. I think one conclusion that I've made is that, and I think, we all agree, is we haven't seen the bottom yet. I think it's going to take a long time to play out to really unravel all the layers of poor policy that have been put in place. I think the one thing is to watch is going to be the earnings for corporate earnings for Q1 and Q2 next year after the winter, the energy crisis, everything. I think you're going to see some big time blood in the streets then. As we've seen over the past month and a bit, there's always bear market rallies where people are going to be like, oh yeah, new bull market started.
Right.
But, you just have to proceed with caution in those. You can play them, but make sure you don't get trapped because it's a staircase up and an elevator down, right?
Yeah, it happens fast. Well, it was in 5 days, the whole month was wiped out of gains.
Yeah, it's
this
pretty
past
bad.
month.
But, in general, do we think that this crash and crisis will be as bad as the 2008 one? I mean, I'd like to say no.
I was looking at a chart the other day, and it was showing how the S&P has been performing versus the 2008, and the chart looks almost identical.
Yeah, that's eerie, right?
Yeah, and if there's any indication, I think we're sitting at 3,800 right now on the S&P. We will go down to 3,200. We'll lose another 15%.
That's right. So the max that the SPY has fallen this year from I guess it was bottomed out in June was 25% from the peak. And as we looked at from the 2008 crisis, the SPY fell 46%. So we might have another 20 to whatever percent to go, which is significant.
Yeah.
When are we going to see that? No one can really predict. It could take another year for the stock market to really reflect how terrible the global economy is. But
so where a lot of this comes from too, is back in, I was looking a bit deeper. I obviously didn't live through the 1970s, but there was the 1970s inflation crisis, and food rose from 2% to 15% over the course of 15 years. A lot of this was caused by the energy crisis, so OPEC raised their rates. During this time, unemployment rose up to 10%, so they experienced stagflation. This is a really, really, really bad time, and they do not want to see this again. So there's a lot of policy missteps that occurred under, it was President Ford, President Carter. So it's kind of like Biden right now has inherited just a massive problem.
right.
It wasn't necessarily his fault per se, but it was, what was it? Jimmy Carter. When he finally stepped into power, he appointed this guy named Paul Volcker, who is the Fed chairman. And he's just like, I'm clamping down and we're going to keep hiking the Fed rates. And it worked. So he was appointed in 1979. They're experiencing this super high inflation. Inflation peaked at 20%.
Holy shit.
Yeah. Right? Pretty crazy. So
what's his name? Powell was referencing Volcker in
Yeah.
his last speech. And I think that's why everyone was like, sell,
Exactly.
sell, sell, sell,
So
sell.
this guy, he's like, no, I'm doing it.
Yeah.
He just kept. So interest rates reached the highest annual average of 16.63%. That's what the interest rates ran up to. We're sitting at 2.5% right now.
It's a long way to go.
Right? And 8.5% inflation. So technically we're far off from that 20, but they don't want to get to that point.
Yeah.
Right? But you can see how far they can actually raise these interest rates. They've done it to 16% before.
Yeah, that's extreme.
So
The thing I feel about those inflation rates when they post them is they are just not accurate at all. I feel like they don't want to tell the full story about how bad things are, because you've seen these charts. It's like people are independently tracking prices of gas at the pumps, food at their grocery stores, and it's all 15%, 24%, everything. And then they're like, oh yeah, inflation is 7%. It's like, how does that add up? It's just
year over year, right? So it's like, oh, it's all gone up.
Yeah.
Right? Like over the past 2 years, but then it's like, oh, well, versus last year, it's only up 7%.
Yeah. It's all bullshit. I think it's all bullshit. We know that though. And then, a lot of the other warnings you can see, many of the world's top investors, Ray Dalio, Michael Burry, the guy who called the 2008 crash, they're all basically putting out massive warnings right now. They're saying this is not the bottom. Burry sold his entire stock portfolio last quarter and bought what his only position is in a prison company.
Yeah, I think he also holds the housing. There's a what's it? I don't have the ticker on the top of my head, but there's one where you can short the housing market as well.
Right. Yeah, he would do that.
Yeah.
So if Christian bails against the market again, then I mean, look, you just take. Sometimes it's difficult because we get so caught up researching projects, and we want the market to go up and blah blah blah. But when you look at all these factors, you look at previous crashes, you look at everything that's going on in the world right now, you just have to be bearish to a certain extent. And as we've talked about in our previous episodes, bear market opportunity, top bear market, this is a great opportunity for everyone. If you are liquid and you have cash in the sidelines, you should embrace the bear market, embrace another 12 months of low prices, because it'll allow you to dollar cost average into all the top stocks and cryptos that you can, that will eventually rebound. The market always recovers. And by studying previous crashes, you can kind of take solace in the fact that it's just a cycle. It's a cycle, up and down. That's how it goes. That's how the market goes.
Yeah. One thing. So I guess if we're going to come out with, do we have any stocks or anything we can say that you'd pick during these times? Or
I mean, we have recession-proof stocks.
Yeah, we do.
We'll link that episode at the end of this one.
Probably an episode to check out.
Yeah, recession-proof stocks. That's like the one. We made that even way before this recession was called.
Yeah.
So yeah, check out the recession-proof stocks episode. There's some bangers in there for sure.
Yeah. I mean, what else do we have on the horizon here? We have China potentially invading Taiwan.
Yeah.
That could be a black swan event that could send the market a bit further.
Mm-hmm.
A few other things.
I mean, there is the midterm rally.
Which
if you're wondering what the midterm rally is and why that could potentially spell another bear market rally to come, check out that episode we posted last week. But that is something that's on our near horizon timeline that could provide some gains opportunities, some light at the end of the tunnel. But then, that's why we say maybe we bounce up for the midterm rally now and then back down to the final bottom sometime in 2023. And then we have the Bitcoin halving coming up.
Yeah. I mean, Bitcoin's been around since 2009. It is relatively close, the next halving. It's only 580 days away or something like that.
I just wonder that, Bitcoin's never seen an economic environment like this. It was born out of the financial crisis.
It was born during quantitative easing.
I mean, he made it because of what happened.
Right.
Or he or they or whoever made it. And now it's never seen, the macro environment, the tightening. It's never seen that. So everyone's like, oh yeah, no, just halving will go up. Halving will go up. I feel like nothing is certain in the market. So we'll have to play it by ear. You'll have to make sure you like and subscribe to the channel so we can keep you updated with everything that's going on.
That's right. Like we do. And tune into the next episode.
That one's going to be a banger.
All views expressed by speakers on the BeanPod are solely their opinions. You should not treat any opinion expressed on the BeanPod as a specific inducement to make a particular investment or follow a specific strategy, but only as an expression of their opinion. This podcast is for informational purposes only.